Hello, and welcome to another episode of the AI Cash Grain podcast. Today is May 17th. I'm Satish Nandapurkar, Director of Data-Driven Strategies at Quantum Hedging. And in this week's podcast, first we'll go to Cy Monley, and he'll talk a little bit about the price action in both corn and soybeans this week. Corn was down 15 cents. It was a big move down for corn, closed at 476.50. Soybeans was down just 2 cents and closed at 12.03 and a quarter. Then we'll go to Kevin McNew and talk a bit about the models. The corn model was the same as last week, pretty much. 50-50 proposition until mid-June, and then a bit bearish, 75% chance of being lower by August 31st. That's right in line with seasonality, what typically happens with corn. With respect to beans, the model is the same as it was the previous week, 50-50 to June, 50-50 to the end of August. So kind of neutral, the model's saying for beans, we can go either way. Kevin will give us some more insight into that. As for Rex, I'll come back at the end after Kevin and talk a bit about the Rex. This week, our Rec is to hold. With the neutral stance out to mid-June for both corn and beans, the model's basically saying, and the simulations are basically saying, be patient. Let's wait for more data. Let's see what happens. Be patient. We're already a little oversold, 25% in corn, 25% in beans relative to our benchmark. Just hold with that, and let's wait for more data. And with that, I'll turn it over to Cy. Cy, give us your insights on the trading this past week.
Thanks, Satish. On the fundamental news, it's all weather, both here in the U.S. and internationally. I'll start with here in the U.S. and essentially we're watching this late planting delay keep a firm bid under corn. And while we've had some progress and essentially we're on track mostly, the next 2 weeks really looks extremely wet. I'll show you here. This is the next 10 days right here with the coverage. I mean, look at that. That's pretty intense. So I think the market, both corn and soybeans, especially the November and the December contract, probably hold together until that looks like a drier forecast. But right now, probably coming in Sunday night, Monday, my guess is corn and beans hold together on that. I think that's the driving factor. The other thing is international weather, and the two factors are driving for beans. It's Brazil. You've got extremely wet pattern causing some delays in harvest, and the idea is it could be as much as 5 million metric tons that just don't get into the ports of Brazil, and that business is probably going to come here, and you're seeing that in cash markets. Cash markets have firmed. Causing people to scramble, and you see the July bean contract holding up. The July meal contract is holding up, and that's a short-term issue. We'll see if that gets resolved. The other thing is Russia. Russia wheat crop has had a bunch of problems, and I think the wheat ripping and doing what it's doing is bringing a firm bid underneath the corn market. We don't know if that goes away just yet, so we'll see. Now there is some rain in the forecast for Russia. But it's in 11 to 15 days. So we'll see if that verifies. And speaking of Russia, their war over there in Ukraine is starting to heat back up. So I think that will keep a bid underneath corn and wheat as well. However, if the weather flips and we do get a dry pattern in wheat for the wheat areas in Russia and in our areas, global prices are still pretty high, and there is an apple supply, so prices would set back. Not yet, but we're going to have to watch the weather break and verify. Thanks. Kevin, what are our models saying with this?
Hey, thanks, Cy. Wet, wet, wet. That seems to be the outlook as you show on those weather maps. It definitely is something that we'll be watching. Our corn model in particular is showing some sensitivity to weather and pulling some of that in. Our latest forecast is a little lower. Last week we had a little more upside in our forecast in the near term because of some of this weather stuff, but now we back down, and that's somewhat just reflective of prices falling, and so there's kind of that expectation from the model that it'll be harder to get up to those higher levels just on kind of the bigger sell-off this week. But overall, we kind of still suspect that by the time we get into the later half of the season, into the late summer, early fall, that prices will be lower, not substantially lower maybe, but at least at this point, we're looking for continued downside risk as we move forward in the season. The other thing we'll be talking about is some of the other features that are adding to this story that I'll circle back to here in a minute. In terms of directional probabilities and directional forecasts, pretty much all of our forecasts in the month prices moved down this week in reflection to where the market is today. And pretty much our model is looking for lower prices for the balance of June and beyond. And our probabilities are kind of sticking where they were last week. For beans, it's a different story, and the bean market, was pretty immune to the corn sell-off. Only down a few pennies from last week's close on Friday, and our model versus last week is a little lower, but pretty much still kind of telling the same story. A little bit of strength here into the early part of the summer, and then maybe dipping lower into later fall. Right now, there's just not a lot for our bean market model to kind of attach to and say this is really giving us a firm directional bias. There's some things that are playing into our forecast, but I think our bean model will probably start to shift more as we get more information as we move into the season. But right now we feel good about kind of where our positions are from a cash advisory standpoint. We did see some up movement here on some of our forecasts, and our directional probabilities just nudged up slightly. But again, we're kind of waiting on more input from data and features that can help our model kind of get more of a directional bias. Right now, it's kind of trying to hug the line of neutrality, if you will. And that kind of brings me to kind of some stuff I wanted to talk about with you all is like, how does our model look at various features and how does our AI system work? I thought I'd share a few kind of points around this. The first is, AI, is one of these things that is so bantered around in today's world that I just kind of want to explain it. First of all, AI it's a model. It takes data, it tries to make predictions, but I also want to set the expectation that it's not a crystal ball. Markets are highly complex; they're highly hard to predict, and so we're going from a world of kind of 50-50. Markets are almost random and coin flips. And with AI, we're hoping that we can target and find some of these features, these data elements, if you will, that really give us a competitive lean. So going from a 50-50 world to, say, a 65% chance of success or 70% chance of success, that's really what our goal is in using AI. The other thing about our model and our model structure is that features don't have to stay in the model at all times. We start with a bundle of over 300, nearly 350 features that our model is really kind of looking at from a statistical and prediction standpoint to say how good do these features or subset of features work at any given time of the year. So the features can kind of come and go. There's an ebb and flow, if you will, which seems natural because there's seasonality. What drives markets at different times of the year? We're now starting to get into the season where weather is impactful. If we were talking about January or February, we'd be looking at South America weather, not US weather. And so our model starts with this basket of over 350 features. And basically our model is picking up on which of these features has had the best impact at predicting prices. And those features, not only do they change, but also we apply different weights to them based on kind of predictability and things like that. And I wanted to kind of pose a question. This isn't a live video, but if we were in a live video, I might ask you the question: what would you think would be a really impactful feature for predicting what the corn market's going to do between now, let's say mid-May, and the end of September? Which of these three features would you think is most impactful in predicting price direction? So, we're not in the middle of the growing season. We're not, weather comes into play here, but, mid-May is really kind of the preseason of the growing season. So let's think about of these three, which would you think would have the most impact in predicting prices between now and the end of September? Would it be U.S. corn acres? Would it be South American corn exports? Or maybe it'd be some sort of like market structure, structure information like the CFTC fund positions. You hear this bantered around a lot by other analysts. Are the funds long? Are they short? The managed money, all that kind of stuff. So would it be corn acres? Would it be South America corn exports? Or would it be CFTC fund positions? And I think probably most of us would think, well, of the three, maybe U.S. corn acres. That might maybe have the most impact on price direction, and maybe CFTC fund positions. But in actuality, what we find from historical data is that it's actually the B. It's the South American exports. And so that might be surprising to you, but that's the beauty and the value of AI is we can have our preconceived notions as market followers, or even in my case, in Cy's case, we've been in markets forever. But we're going to let the data speak for itself, and that's the beauty of AI is it can sift through and filter and test a lot of different data and see which does come up best. And so in this case, what we have is a chart showing 30 years of relationships between what the value of South American exports have been relative to last year. So that's on the x-axis, and then on the y-axis is the percentage change in corn futures between mid-May and the end of September. So above zero, that means the corn market went up. Between now and the end of September, below the zero line, it's obviously going down. And you can see there's a trend line through that. It's not perfectly correlated, but there is certainly some correlation here. It's about a minus 0.7 correlation. So that's actually pretty high. And what that tells me is that, as South America's exports increase versus last year, that tends to put pressure on our ability to end higher by September versus now. And then you really need, if you look at the far left part of this axis, there is a plus 50%. There's some positive values there when we get X below minus 5. The other way you could think about this is kind of clustering these points. And this is another thing that our model does, is it looks for clusters of points that are similar and give us kind of a probabilistic view of it. So if we kind of look at the first cluster that I've outlined in red, this is the cluster of points where South American exports are increasing. That is, they're greater than zero versus last year. So they're increasing versus last year. I've highlighted the points in the red box. And what do you notice about those points? None of those points, none of those years did we see prices increase by the end of September. In other words, all of those years ended lower versus where we're at today. On average, we were down 7%. Okay, that's a pretty telling statistic. It's not just 1 or 2 years. There's actually about 9 years in this cluster. So you've got a lot of data that kind of says, when this happens, where South American exports are increasing versus last year, it's pretty likely that prices will not increase or end higher by the end of September. Now, let's go to the left on the chart a little bit. Let's look at the next cluster of points. This is from 0 to minus 5. So now we're kind of talking about, okay, maybe South American exports are just slightly lower, or maybe minus 5 lower versus last year. There is only now just 1 point that is above zero. The rest are still below zero, and the average is minus 7 as well. And so, we're seeing, not much improvement, even though our slope on our line is better. From a kind of probabilistic standpoint, there's not a lot of evidence here that this is all that supportive. And I might note that where we're at today is actually in this orange area. So we're in the orange area, which is not necessarily favorable for higher prices. And then finally, if we did find ourselves with a big drop expected in South American exports, less than minus 5, now we see that probability change. We go from nearly no instances of seeing prices rally to now we actually have 83% of the data showing us that prices rally. Unfortunately, that's not where we're at today. But this is just I wanted to just kind of share with you some of the under the hood aspects of how our model looks at data, how it kind of compares it and comes up with model predictions. So Satish, back to you and talking about our strategies.
Thanks, Kevin. So let's just go over where we stand for both corn and beans and the recommendation this week. So for corn, we coming into the week had a slightly bearish stance. We're 25% sold in corn. Our benchmark, our TPCI index, is 20% sold. So we're a little oversold. The models have been telling us to get a little bit oversold. We had a slightly better average price. Our average price is 473.50. The benchmark is at 472.63. So we're a little bit ahead of the benchmark, but we're also a little bit oversold. And as I mentioned, because the models are neutral out till mid-June and we're already a little bit oversold, the recommendation is simply to hold for now, be patient, do nothing further in corn at this time. In beans, similar situation. Where we stand is that we are again have a slightly bearish stance. We're 20% sold, 25% sold, I should say, in beans. The benchmark is 20% sold. We have a slightly better average price. Again, 1176.10 versus 1169.69. Beans are more neutral at this point. The models are showing neutral short term and longer term. So again, the models are respecting that and effectively saying, let's hold, be patient, wait for more data. Again, our goal with our recommendations is try to beat our benchmark index, this index that sells a certain percentage at the end of every month. And our simulation models take our forecasts, simulate out the crop year 1,000 times going forward, and says, what's the best selling strategy given the forecast to beat the index? And right now, in both corn and beans, it's saying, let's just hold. We're already a little bit oversold relative to the index. Let's just hold and keep it that way. And with that, let's do a little recap. Cy had talked about rain delaying planting here in the US, maybe supporting both corn and soybean prices. In addition, with respect to corn, the weather in Russia causing some issues with the wheat crop there that could be supportive for corn as well. And down in Brazil, the rain and the flooding really limiting exports, that exports have stalled. And that might be supportive for beans in the short run. So there's a couple of weather issues that might be supportive there. The models, Kevin talked about the models. The models, again, are 50-50 in corn, 50-50 in beans out to mid-June. We're bearish corn, 75% chance lower by August, but 50-50. Beans is very much neutral, short run and long run. And then as for recommendations, the recommendations in both corn and soybeans is to stand pat, 25% sold in corn, 25% sold in beans. It's to stand pat and just hold this position for now until more data comes in. Thanks again for listening. Thanks again for being a subscriber. And as always, we will be here next week with another episode of the AI Cash Grain podcast. Thank you.